Happy Wednesday out there, Team 42. It's your skipper here, Darius to present our macro minute for Wednesday, December 3rd, 2025. As always, we'll start with the executive summary from today's lead-off morning note. So let's hop right in. Today's key macro question is, what do the latest key high-frequency economic data signal about the health of the U.S. and global economies? The short answer is the U.S. data were generally supported our U-shaped economy thesis and suggest the Fed is falling further behind the rates curve. The global data were mixed, but generally point to a global economy that is chugging along just fine amid heightened macro policy uncertainty. In terms of analytical nuance, the November ISM economy-weighted composite PMI data supported our outlook for accelerating above consensus growth. The November ISM services PMI data supported our resilient U.S. economy theme. The November ISM economy-weighted composite PMI data supported our resilient U.S. economy theme as well. And then the ISM services PMI data supported our tariff, pig, and the inflation python thesis and suggests we may be approaching the end of that process. The weak negative impulse in November auto sales data supported our U-shaped economy thesis. The strong negative impulses in the September industrial production and capacity utilization data supported our U-shaped economy thesis. And the strong negative impulse in the November ADP private payrolls data supported our U-shaped economy thesis and suggests the Fed is falling further behind the rates curve. The sharp deceleration in median annual pay for job changers in the ADP survey at 6.3% year over year, which was the lowest since January of 2021, supports our U-shaped economy thesis and also suggests the Fed is falling further behind the rates curve. The 10-year nominal treasury yield is at roughly the same level as the Fed funds rate. Rarely in history is this dynamic sustained. Historically, the 10-year is roughly 120 basis points wider than the Fed funds rate, and the current spread implies the 10-year should be either greater than 5% or the Fed funds rate should be at or below 3%. Somebody's wrong there. We're guessing it's probably the cabal of unelected economists as opposed to the hundreds of millions of market participants around the world. According to the November final composite PMI data, Europe and Japan are outperforming other key economies in growth momentum terms. Lastly, consensus short-run potential real GDP growth estimates are trending higher in the U.S. and in the China and the U.S., sideways in Japan, and lower in the Eurozone and U.K. Consensus short-run potential real GDP growth estimates are also trending higher in India, sideways in Brazil, and lower in Australia, Canada, and Switzerland. And then consensus short-run potential headline CPI estimates are trending higher in the U.K. and U.S., sideways in Japan, and lower in China and the Eurozone. And then finally, consensus short-run potential headline CPI estimates are trending higher in Australia and Brazil, and lower in Canada, India, and Switzerland. And for those who may not be familiar, when we say consensus short-run potential real GDP or headline CPI estimates, that's just taking the blend of the 1 year forward and 2 year forward estimate to get a general sense of the general growth rate that the Wall Street consensus is sort of applying to each of these economies. That removes the impact of base effects from that calculus to get a sense of, hey, are people just generally revising up their growth expectations because there's obviously a good policy mix in support of growth, so support of demographic and productivity dynamics, or vice versa. And same obviously with inflation and for the drivers of inflation. So obviously trending higher is good for growth, trending higher is bad for inflation, and vice versa. So as always, members of our global investor community can trust that our institutional grade risk management overlays, KISS and Dr. Mo, will help our portfolios navigate these emergent risks better than investors attempting to manage risk without systematic rules or relying on fundamental research alone. Transitioning to our 42 macro dashboard here, as always, we'll wrap up with a question from our community. This one's titled Small Businesses in the Fourth Turning. It says, hello, Team 42 and community. I've been a subscriber for about a month, and I'm excited to utilize KISS to manage the larger majority of my liquid net worth. I've recently come across an opportunity to buy a small business with steady cash flow in the home services sector. I'm excited about the opportunity to purchase this small business. However, I'm beginning to wonder what the implications of the fourth turning will be on small businesses. As the fourth turning progresses, what types of impacts should we expect to see on small businesses across America? So excellent question. I'll start by saying it's hard to ascertain that answer without applying some sort of sectoral specific overlay, because obviously there's a lot going to change in the economy, particularly as it relates to the sectors that are going to be more or less impacted by AI. There's going to be a lot of dispersion in the coming, let's call it 5 to 10 years in that regard. So tabling that, the one thing I will say is one thing that's consistent across fourth turnings that we identified in our investing during fourth turning research, which was an empirical deep dive study that we performed in the summer of 2023. One of the things, I figured out a lot of things, but one of the more important key takeaways from that study was you tend to see explosive growth in the size of sovereign, just general explosive growth in the size of government and government borrowing. And as a function of that, taking this back to small business, what's likely to happen is that we see an increasing crowding out. As long as the Fed is not monetizing debt at a rate that allows for that capital, for that crowding out impact to ameliorate. This is exactly what we're seeing here, and it's contributing to the K-shaped economy. So if you think about, throw a few statistics at you. If you think about the approximate next 12-month marketable treasury debt supply that we've seen in terms of the time series there, that statistic, which is now well north of $11 trillion, up from about $4 trillion prior to the pandemic, that statistic is now gobbling up about 36% of global savings, up from a long run mean of about 22%. That same statistic is gobbling up about 215% of US savings, up from a long run mean of about 120%. So the delta between the current amount of savings that Uncle Sam is essentially gobbling up relative to the long run means of those time series, it suggests that that is the kind of amount of crowding out. Those savings, instead of being going to capitalize small businesses, going to capitalize mortgages, going to capitalize other things that are sort of being left behind in this K-shaped economy, they're not going to those places, and they're essentially going to capitalize the explosive growth of the public sector balance sheet. And so it's essentially like the economy is having a stroke, if you will, in the sense that the money which used to go to support small businesses and other private sector economic activity is no longer doing so. So if we assume that we're not going to this sort of explosive growth of the fiscal balance sheet, the explosive growth of the public sector balance sheet is unlikely to end until we're on the other side of the fourth turning, because obviously it's probably going to even accelerate from here as we approach the climax phase of the fourth turning. If that is true, and obviously we believe it is true, if that is true, then it's unlikely this crowding out impact is going to ever really truly be fixed or solved. It might go ebb and flow, particularly next year when we start to see the impact of what we've been calling for, which is structural regime change at the Federal Reserve. If we start to see structural regime change at the Federal Reserve, which made monetary policy a little bit more supportive of diverting, of sort of not diverting, but really just ameliorating the impact of that explosive growth of public sector borrowing. If you can sort of make that digestion process a little bit easier from a monetary policy standpoint, then you would ultimately have a little bit more trickle down in terms of the capital flows that could go to capitalize small businesses, the mortgage market, et cetera. So that's something we're expecting. That's been part of our paradigm C view since we opted the paradigm C theme back in mid to late April. So obviously we've enjoyed this tremendous 42 macro paradigm C bull market since then. So we'll wrap it up there. Darius still here presenting our macro minute for Wednesday, December 3rd, 2025. Best of luck out there today. We'll catch you back here tomorrow. Actually, no, we won't catch you back here tomorrow. I'm going to be offline preparing our December 2025 macro scouting report. So we'll be back online Friday to present that as well as our macro minute. So we'll catch you back here on Friday. Everyone have a wonderful couple days. Cheers.